This week, all the attention has been on Italy. We can see that the Italian spread relative to the German 10-year bond yield got to about 120 basis points during April, early May, since pushed out to about 284 basis points at the peak here, and has rallied just in the last few days back to 237 basis points. At the same time, the red line is the Italian 5-year bond yield. That pushed up from about 0.6 up to 2.8% over the course of the month and has since steadied back to 2% in the last 2 days. What about the equity market? So the Italian equity market has, after being one of the best performers during 2017, has come down quite sharply over the past month or so, down around about 12%. Once again, a bit of a recovery in the last few days. And then, of course, the impact on the euro. The euro had already been weakening in the early part of this year as growth disappointed in the European region, while growth in the US was, if anything, towards the upper end of expectation. So the euro was already on a weakening trend, but it's certainly been exacerbated by the developments in Italy, where the prospect of uncertainty around the eurozone has perhaps got some investors at least thinking that the ECB would go easy on its moves towards quantitative tightening, and that has subsequently led further to euro weakness. So these have been the developments that we've seen over the past couple of weeks in particular. At the heart of the surge in the popularity of the Five Star Movement and the League parties at the March 4 election, who together won 33% and 17% of the vote, is a general dissatisfaction with the very weak economic environment facing Italy, also concerns over migration policies, and just a general dissatisfaction with the traditional parties. Markets had feared that the inability of the two anti-Eurozone parties could lead to an elongated process of uncertainty, possibly new elections later in the year, and the risk of another European or Eurozone crisis. Ultimately, the possibility of the demise of the Eurozone itself. So these have been the concerns that have been undermining Italian markets in particular, but European markets and global markets more generally. A deal to form a coalition government on Thursday appears to have steadied things for the time being, but in the next few slides we're just going to look at the economic backdrop and consider that although we might have a short-term solution here, that the underlying problems remain. So we're going to have a look at some of the key macro indicators and how they've developed over the past 10 years, or indeed since the global financial crisis. So we're looking at GDP in the Eurozone here. This is actually the EU19, based at 100 at the end of 2008, and you can see that the European economy generally is about 9% larger than what it was at the end of 2008. Now, if we add now into the mix Germany's about 15% larger than what it was almost 10 years ago. Let's add in France. That's the wrong one for France. There's France there. That's around about 10% bigger. Spain, the green line there, has had a very sharp recovery since 2013-14, but ultimately is still relatively weak compared to where it was 10 years ago. And then if we add in the Italian GDP, and this is a real issue for the Italian economy and the population more generally, is that the economy is still basically smaller than what it was at the end of 2008. GDP, that's sitting at about 99. So it's still slightly smaller than what it was at the end of 2008. So if we then move on to look at some other measures, we'll look at unemployment rates. And here we'll just look at those in actual terms. So if we look at the unemployment rate in Europe, it's now, after getting up to about 12%, it's now well below 9%. Now if we add in France, we can find that. Here's Germany. So the German unemployment rate down through 4%. If we add to that France's unemployment rate is still relatively high, but it's come back to about 9%. Spain has seen quite a considerable recovery, down from 26% down to about 16%. But then if we look at Italy, which becomes the purple line here, the Italian unemployment rate has stayed fairly high, been very little improvement, sort of from a peak of around about 13%, sitting at, let's say, around about 11%. So it's been a very slow and very, elevated level of unemployment. Some of the other measures, and I think we have to go back a longer period, perhaps if we take the data back to 2000, we can see how Italy has been disadvantaged, and we're looking at now at unit labour costs. So let's just get the European labour cost index. I'm going to base those at 100. So that's European unit labour costs are up about 28% over that 18-year period. Now, if we add in Germany, Germany has really taken off. Unit labour costs have really taken off since the financial crisis. You can see there, that's the red line. France has stayed actually quite high. Unit labour costs have continued to rise and well above, or above Europe, and certainly well above Germany. If we add in Spain, unit labour costs were rising very, very sharply leading into the global financial crisis, have since eased back. And then finally, if we look at Italy, what we see there, Italy sort of mirrored what was going on in Spain, but hasn't had the same recovery. So unit labour costs in Italy are about almost 40% higher than what they were 17, 18 years ago, and probably 10% higher than what they are in Europe compared to where they were 17, 18 years ago. So from a relative or a competitiveness point of view or productivity point of view, Italy is also lagging in that regard. Now, if we look at debt to GDP, so let's look at, this is European general government net debt to GDP. So in Europe, it got to about 75%. It's come back down to about 70%. If we now add in Germany, Germany's down after getting as high as 60%, down to about 42%. France is up here at in the high 80s. Spain also in the high 80s, as we had that shift from private sector debt to public sector debt in Spain in the aftermath of the GFC. And then Italy, as we know, much higher than the rest of Europe, sitting up above 120% of GDP and showing very little sign of improvement. And that's obviously going to be heavily related to the inability to grow the economy. Now we'll just look at the fiscal position, and what we'll do here now is strip out the interest payment component, so you're left with what is called the primary deficit. So it doesn't take into account interest payments on debt. And so here we have, this is for Europe overall, so it's roughly in balance. And if we bring in Germany running a primary surplus, so as it has quite often over this 17, 18 year period. France still running a slight deficit. Spain also has been in deficit most of the time, almost back to balance. The interesting thing here, though, is that Italy, once we add Italy in, that's the purple line, that's actually running and has consistently run a small surplus. And this is a primary surplus, and this has often been a concern of markets, that Italy could withdraw, it could default on its loans because it does run a primary surplus. As we know, though, however, what the overall budget deficit is actually is in deficit because of the interest payments. So this is an interesting situation for Italy, running quite a healthy primary budget surplus. And then finally, we just have a very quick look at the bond yields, and we'll look at those in actual terms. So if we get the German 10-year yield, you can see that one there is has come down to about 0.3 in recent days. And if we add in the French bond, followed by, let's put in Spain, and we'll put in Italy. And so you see that Italy is the green line there, is once being roughly in line with the Spanish 10-year, is now above the 10-year and having moved up sharply in recent times. And then we also add into the mix Portugal. If we can find the Portuguese bond yield, you will see that Italian bond yields are actually now slightly above the Portuguese 10-year bond yield. So the conditions, although there's some stability creeping into the Italian markets, just in the last couple of days, there's some severe underlying economic problems that we feel investors are going to continue to have to pay attention to. Thank you.